Well, we're looking ahead to bank earnings out Friday, kicking off third quarter earnings season. You've got JPMorgan, you've got Wells Fargo, BlackRock, Bank of New York Mellon, BNY, and all of them set to report here. Joining us now, we've got Argus Research's Director of Financial Services Research, Stephen Biggar. Stephen, great to have you here with us this morning. So, of these banks that are essentially going to give us the forecast, the economic type of forecast and backdrop, at least in the purview of what they're seeing in engagements with their clients, how do you think that's going to set the tone for this earnings season?
Yes, good morning. I think, well, yeah, you're right. Banks usually do set that tone, and I think we're looking at, an interest rate scenario here that is going to be beneficial for banks and beneficial for the market. So, it's odd that as bank analysts, we typically root for higher interest rates because that's better for net interest margins. But there has been a point where these high rates have kind of worn out their welcome. So, if we get some better, lower rates here, that will help stimulate some of the loan growth, which has been very, very weak. That will help take some of the pressure off deposit costs, which have also been elevated for banks. And then also kind of helps with the increasing the odds of a soft landing. And that will help with loss provision. So, that slower economy has produced higher unemployment here. To the extent we can take some of that pressure off, we get lower loss provision. So really a triple boom for the lending business if lower rates pan out.
But Stephen, what happens if the Fed does delay the rate cutting cycle just a bit? And I bring this up because, yes, financials are supposed to be, I guess, slightly lower than where they were a year ago as a group. But when you take a look at banks specifically, that subgroup expected to show a 12% drop from a year ago. So if we do see a further delay, maybe in some of those expected rate cuts, what does that setup then look like for these larger banks in the second half of the year?
Yes, well, so we have been counting on lower rates, and of course that is a double-edged sword and hurts on the net interest margin front. But to the extent that the banks are pretty well hedged here, the economy doesn't fall off a cliff. I think again the Fed has kind of navigated a path towards lower rates, or at least is there in case the employment situation gets a little worse. They'll lower rates some more. So I think banks are pretty well hedged, and they'll do okay. Loan growth has not turned negative. Loss provisions have not increased to the point that it's really hurting profitability at this stage. And then you've got the capital market side, which is showing some signs of rebound. So I think all told, the next 6 months probably better than the last 6 for banks.
And so with that in mind, the net interest margin bottoming process, we've heard that be discussed by many of your industry colleagues. Do you believe that that's finally seen a trough, and how will that be reflected in these reports that come across this week?
Yeah, as I mentioned, I think in particular it's the high deposit costs that have really been putting pressure on those margins. So to the extent that we already had the first rate decrease from the Fed, that's going to take some of that pressure off deposit costs, and net interest margins should begin to stabilize here and potentially move higher again as those deposit costs get a little more favorable for banks.
So, Stephen, what's your top pick then going into this earnings season?
Well, we still like JPMorgan. They are not the biggest beneficiary of lower rates. They've got a lot of close to $1 trillion of deposits that earn nothing. So they would benefit as rates went up, but won't benefit as much as when rates have moved back down. However, they've got terrific capital markets franchise. I think they typically are best in class. They're growing share there. So we expect good things out of JPMorgan. Certainly the favorite amongst the biggest banks. And then secondly, you've got Morgan Stanley, which I think is also again, because of the rebound in capital markets business and the wealth management franchise, which is about close to half their business. I think that does well too, given the rising values of stock prices and fixed income values. So that should benefit the wealth management side also.
All right, Stephen, always great to have you. Thanks so much for joining us here this morning.
Thank you.